Dividend investing and index funds are the two most common ways to build wealth in the stock market. And you have likely heard both terms mentioned in every corner of the internet, often with people arguing that one is clearly superior to the other. Some say dividends are the only real way to build wealth. Others say index funds always win. Most explanations stop at the surface. By the end of this video, you will understand exactly how each one works, how they compare over 10, 20, and 30 years, and which one actually builds more wealth for most people starting out. Before we touch on any financial terms, let me give you a picture. Imagine two farmers. Both plant fruit trees on the same piece of land, starting with the same budget. The first farmer harvests fruit every season and sells it immediately. He gets cash in hand, a reliable, predictable income. He can spend it, save it, do whatever he wants. But every apple he takes off the tree is one less apple producing seeds for next year. The second farmer never sells the fruit. Every time a tree produces apples, he uses them to plant more trees. His farm looks quiet for years. He is not collecting cash, but slowly, almost invisibly, the number of trees keeps growing, and each new tree produces more apples, which plant more trees. After 10 years, the first farmer has collected a lot of fruit. The second farmer's land is covered in trees. After 30 years, there is no comparison. That tension between collecting income now and letting growth compound quietly is exactly what we are about to explore, because those two farmers represent the two main approaches to building a portfolio. Let's start with the second farmer's approach. Imagine someone built a basket. Inside that basket, they put a small piece of every major company in the United States. Apple, Microsoft, Amazon, JP Morgan, ExxonMobil, the 500 largest publicly traded companies in the country. When you buy a share of that basket, you own a tiny slice of all 500 at once. Your money rises when those companies collectively rise. It falls when they fall. That basket is called an index fund. Specifically, when it tracks the S&P 500, the 500 largest U.S. companies, it becomes one of the most straightforward investment tools ever created. The two most widely used versions are VOO from Vanguard and SPY from State Street. Fidelity has their own version too. You can buy all of them on any standard brokerage platform. Here is what makes index funds remarkable: the cost. VOO charges what is called an expense ratio of 0.03% per year. On a $10,000 investment, that is $3 a year, not 3%, $3. Fidelity's zero-fee index funds charge literally nothing. On $10,000 invested, an index fund costs you $3 per year. An actively managed fund doing the same thing might cost $75. That difference compounds over decades in ways that genuinely shift the final number.
Now, the important thing to understand is what index funds are not doing. They are not sending you cash payments. They are not generating income you can spend. When Apple's stock price rises because they had a strong quarter, that gain stays inside your fund. It reinvests automatically. Your balance grows, but nothing lands in your bank account unless you sell. For most people in their 20s and 30s, this is actually the point. The money stays in the machine. It keeps compounding. There are two honest limitations worth naming here. First, index funds follow the market. If the market drops 30%, which it has done before and will do again, your portfolio drops 30%. There is no cushion from dividend payments. Your balance simply falls, and you have to sit with that. Second, and this matters more than most people admit, index funds are boring. Nothing happens. No cash arrives. No signals that the strategy is working. For some investors, that psychological quiet creates doubt. They start questioning the strategy right before the recovery. Index funds are built for someone who can automate contributions, check their account infrequently, and genuinely not react when the market falls. Now, the second approach feels very different.
Dividend investing is the first farmer. When companies generate profit, some of them distribute a portion of that profit directly to shareholders, typically every quarter. If you own shares of Coca-Cola, the company sends you a small cash payment based on how many shares you hold. Same with Johnson & Johnson. Same with Procter & Gamble. These are companies that have been paying and growing their dividends for decades. The income feels concrete in a way that index fund growth does not. Money arrives on a schedule. You can see it. You can choose to reinvest it or spend it. There are funds built entirely around dividend-paying companies. SCHD, the Schwab U.S. Dividend Equity ETF, is one of the most popular, with a yield of roughly 3.5%, meaning for every $10,000 invested, you receive about $350 per year in dividend income. Vanguard's VYM offers a similar structure. That sounds appealing, but there are a few things that change the calculation. The first is fees. SCHD charges 0.06% per year, still extremely low, but some dividend-focused funds, especially actively managed ones, charge 0.50% to 1%. That difference quietly erodes returns over time. The second is tax treatment. This one matters significantly for people investing in a standard brokerage account rather than a Roth IRA or ISA. In the UK and US, qualified dividends are taxed. In the US, typically at 15% for someone in the middle income brackets. Every time a dividend is paid to you, you owe tax on it, whether you spend the money or reinvest it. That creates what is called tax drag. Most investors in taxable accounts do not realize they are losing roughly 0.5% per year to dividend tax before the money even compounds.
Over 30 years, that 0.5% annual drag on a growing portfolio costs tens of thousands of dollars. The third limitation is growth rate. Dividend-paying companies tend to be established, mature businesses. They are paying out profits rather than reinvesting them aggressively. That stability is the point, but it generally produces slower share price growth compared to the broader market. SCHD has delivered strong returns historically, but its total return often trails a pure S&P 500 index fund over a full market cycle. There is also a risk called yield chasing. Some investors hunt for the highest dividend yield they can find, 7%, 8%, even 10% annual dividends. What they often do not notice is that extremely high yields can signal a company in distress. The share price has fallen sharply, making the yield look attractive, when in reality, the dividend is about to be cut. Dividend investing is built for someone who genuinely values regular income, either because they are closer to retirement or because the psychological effect of receiving cash payments helps them stay consistent. Now, both strategies are doing completely different things, and that distinction becomes critical when you look at what actually happens over time. Let's put real numbers on this and follow two investors over 30 years. Both start with $10,000. Both add $200 a month. Both invest consistently through market ups and downs. Investor A puts everything into a low-cost S&P 500 index fund. VOO, 0.03% expense ratio, 10% average annual return, fully reinvested. No dividends taken out, everything stays in. Investor B builds a dividend portfolio using SCHD, 0.06% expense ratio, 3.5% dividend yield, 6.5% price growth, totaling 10% gross return before taxes and fees. At year 10, the gap is small. Investor A sits at roughly $55,400. Investor B, in a taxable account, paying 15% tax on dividends each year, sits at around $52,200. The difference is just under $2,600. Not dramatic, but compounding works on the gap, not just the total. By year 20, Investor A is at $173,200. Investor B is at $158,400. The difference has grown to nearly $15,000, not because index funds are dramatically better year to year, but because 0.5% of drag per year keeps compounding against a larger and larger base. By year 30, Investor A ends at approximately $468,700. Investor B ends at around $415,200. The 30-year difference on identical contributions, over $53,000. That is roughly 2 years of contributions simply lost to tax drag. Now here is the important caveat that changes the calculation completely.
Both investors are holding their investments inside a Roth IRA in the US or an ISA in the UK, tax-advantaged accounts where dividends are never taxed. Inside those accounts, the tax drag disappears. The gap between index funds and dividend investing shrinks to almost nothing, a difference of roughly $4,400 at year 30, driven almost entirely by the tiny fee difference. What this means is that account type matters more than strategy type. Inside a Roth IRA or ISA, dividend investing and index investing produce nearly identical outcomes over 30 years. The difference is behavioral, and this is where most investors actually lose money. Index fund investors receive no cash signals, no quarterly income, nothing to confirm the strategy is working except a number on a screen. During a 30% market drawdown, that number looks terrible, and there is nothing arriving to offset the feeling. Dividend investors receive cash every quarter. Even when the share price falls, the payment arrives. For some investors, that consistent income signal is what keeps them from selling during a crash. And the investor who stays in, who does not panic sell in March 2020 or October 2022, almost always ends up far ahead of the technically superior strategy they abandoned halfway through. At this point, the comparison becomes much clearer.
If you are starting out, investing inside a tax-advantaged account, and your goal is to build the largest possible portfolio over 15 to 30 years, a low-cost total market or S&P 500 index fund wins on total return basis. The numbers support it. The academic research supports it. The simplicity supports it. VOO, VTI, Fidelity Zero, any of these, held consistently, will outperform most dividend portfolios on a pure total return basis when you account for tax drag in a taxable account, or match them almost exactly inside an ISA or Roth IRA. Dividend investing still makes sense in two situations. You are approaching retirement and you need actual income to live on, or you are the kind of investor who genuinely stays more consistent when you receive quarterly cash payments. If dividends stop you from selling during crashes, they are worth the small return sacrifice. Neither approach is wrong. The best one is the one you will actually stick with for 30 years.